Would you like an opinion on a financial matter you're dealing with? Whether it's about retirement, investments, taxes, or 401ks, Scott Hansen and Pat McClain would like to help you by answering your call. To join Allworth's Money Matters, call now at 833-99-WORTH. That's 833-99-WORTH.
Welcome to Allworth's Money Matters. Scott Hansen.
Pat McClain, thanks for being here.
Yeah, always good to have people
listeners.
Listening. Yes, because we wouldn't have a show otherwise.
Yes. And thank you for the reviews. I go in and read them about once every 3 months. And so thank you for your feedback. We take some of it. So some of the reviews are you never read. Have you ever read them?
Not in years.
Okay, I do read them, but
yeah, I don't like reading negative stuff.
Yes. But mostly the negatives.
Not that there's a lot of negative stuff on our show.
Oh, it's not. Yeah, most of it is fairly positive.
Anyway, we're glad.
Give us the reviews, please.
We're glad you're here as we're talking about financial matters and take calls and fun with finance and all that stuff.
Is it
fun with finance?
Yeah, is it fun with finance?
We try to make it fun. Finance isn't always fun.
It's a pretty boring topic.
It is increasingly complex. It's really fascinating because we've both been in this industry a long time, and it's just the investment world has become increasingly complex, not more simple. And you would think with all the technology and the ease of doing things, I mean, you can have a Robinhood account and you could do a trade super simply. That's
okay.
But it's still exceedingly complex when it comes to all the different types of investment products, all the different types of tax strategies that you need to employ.
That I would agree with that. The
balancing
investment
them all
things,
together.
I think the menu of choices is increased. Our investment philosophy has not changed as a result of that. Much.
Much, a little.
But it's much
there's new products.
It's much easier to be tax efficient in today's environment than it was even 10 years ago.
Yeah, because of technology.
Technology and friction in trading cost. Right? Friction. Now, where the friction is in the cash sweep programs.
Oh, yeah, that's been interesting.
You want to talk about that, the cash sweep programs?
Yeah. So when you have money at in a brokerage account, any of the big firms you can think of, or the smaller firms for that matter, any of the firms. So if there's money's not invested, it drops into an interest-bearing account.
Sometimes it's a bank savings account.
Sometimes it's a money market.
Sometimes it's FDIC insured. Sometimes it's not.
It's designed to be stable and liquid. So, or if you have a dividend that comes in from your stock and it's not reinvested, it drops into that. Well, particularly as trading fees have gone to zero, a source of revenue for a lot of these firms is the spread that they can earn on the difference between the interest they pay you and the interest they could earn on their own safe liquid dollars.
Not just a source. For many of them, it's number 1, 2, or 3 highest revenue source.
And for a number of years, that revenue source was gone because interest rates were essentially zero.
There was no money in what they call the spread.
They couldn't make any additional money. They weren't getting. There was no additional revenue off it.
So let's use. You've got an account at
Acme Brokerage,
right? That's owned by Bank of America.
And if you Google the news, there's been a lot of
it's called cash sweep programs,
been a lot
and it might pay you 1.5% or 1% or 1.25% on your deposits in that money, but they're turning around and lending it at 3, 4.
Well, they're buying treasuries at 5,
right? They're lending it to someone, either the U.S. government or someone else, or overnight lending, and they're making that spread, which is a huge source of revenue. So what's wrong with that?
I think it's a disclosure issue. I think it's as long as the investor, everyone needs to make money long term, right? If you're broker, if you've got money at a brokerage firm and that brokerage firm's losing money, long term, that's not good for anybody, them nor you, right? So in any business transaction to work for a long time, everyone needs to make a profit. I think the challenge with that, it's the lack of disclosure and the opaqueness. And so as interest rates rose, rather than these firms giving that increase, that benefit to their investors, they kept that. That's right. The challenge.
And as a fiduciary, right, you need to pass that on to the client.
You need to act in your client's best interest.
That's right. Right.
Which might be to use a cash sweep program that plays a lower interest rate because it offsets costs that would have to come in from somewhere else.
It has to be disclosed, though.
Yeah, I mean that's why it's been this.
Yeah, there's every week I've seen someone else is getting
class action lawsuit. Everyone's gotten slapped for it.
Yes. They'll fix it. It'll work.
Yeah, and I mean typically if you have a small balance, it doesn't really matter, right? Relative to your portfolio, if there's a couple percent there, it's not going to matter. If you've got money setting aside there that you're going to be using for a down payment on a house in a year from now or 2 years from now, that's where it makes a tremendous difference.
A lot.
Yeah,
a lot of difference.
Makes a big difference. So, anyway, we're going to take some calls. We also want to talk about Morningstar did a study on the difference between investment returns and investor returns.
What did the investment do, and how did I do relative to that investment?
How come my return wasn't quite what the investment was? And it's not a surprising study. I've seen it over and over, but it's always a good reminder. Yes. So anyway, if you want to join us, we'd love to take your call. You can send us an email at questions@moneymatters.com, or you can call 833-99-WORTH to be part of the program. We're talking with Terri. Terri, you're with Allworth Money Matters.
Good morning. How are you?
Hi, Terri. We're great.
Great. So I have some questions. I'm about to retire. I'm 68, and I have about $1.25 million in tax. I don't know what you call it. They're going to be taxed when I take those funds out. I have about 100
401ks, IRAs, 403bs, that sort of account.
And I got 2 annuities. Actually, 3 annuities. An IRA, a company retirement, a 403b.
Okay.
Because I'm still working, I'm waiting to transfer all that into.
So you worked in a hospital or a school?
I worked for government for almost my entire life, so I get almost no Social Security.
How did you get the 403b?
Because I work for the government, gets a 403b.
It's typically 457 or 401k, but depending on what sector you worked in.
Okay. Right. Well, I work for a university right now.
Okay. Thank you. It was education. Thank you. Thank you. That's when I said you worked at a school.
Yeah.
Okay. Oh, sorry.
That's all right. No.
Okay. We were just trying to figure out whether these are what called qualified annuities or non-qualified annuities, and they sound like qualified.
So I have one qualified annuities, and the two largest are non-qualified.
Okay.
Which means they're taxable, right?
Parts of them are taxable, and it depends on how you take the money out.
How did you end up with 2 large non-qualified annuities?
Well, we went with this financial planner, supposedly a fiduciary. She never asked me, and she just took the money I had and kind of put it in these annuities.
And where was the money in? It's like a savings account or something?
No, it was in a Vanguard account.
Okay.
And an SEP IRA.
A SEP IRA.
Yep.
So they are qualified annuities.
Is your spouse self-employed?
He is.
Okay. All right. I feel we're playing in kind of a game here.
And I'm sorry, yes.
But we're just trying to figure out the sources of these things. So these are qualified annuities. Okay. So
what does qualified mean?
It means that it's tax qualified, that it went in on a pre-tax basis, gross tax deferred, and then comes out taxed. Yeah.
As opposed to saying yanking a bunch of money out of your checking account and buying an annuity that's got a different tax structure.
Yes, which means that you put the money in after tax, it grows tax deferred. When it comes out, it's partially taxed.
All right, so sorry.
Kind of reversed. Sorry.
Okay. So here's what we got from the conversation. You're married.
Yes.
And you're about to retire.
And you're about to retire, and most of this money sounds like it's qualified, which is it's pre-tax. What's the total pre-tax amount between you and your husband? Or your spouse?
Oh, pre-tax.
Money that came from the
About-
SEP IRA or the
Yeah.
403B or an IRA rollover.
Right. Well, he has an inherited IRA, and he also has traditional. He has brokerage. If I add all of that together, like his total dollars are 768 approximately, and 82 of that's in a Roth, but the rest is pre-tax.
Okay. So what is your?
And then-
Okay. Oh, keep going.
I have more. Sorry. I have approximately 300,000 that's in non-taxable, it's in Roths of some sort, or I do have one annuity that I put in post-tax.
Okay.
Okay. So we own our own home. But we do have a small mortgage on the solar system we had put on.
Okay.
So my questions are, one, if I retire now, should I be taking money from my IRA that was pre-tax?
How much
Should
is
I
your
be doing?
How much is your pension going to be relative to what your current salary is?
I have no pension.
Okay, no pension.
They said no pension. Nope. I am currently taking funds from one of the two annuities, the big ones. I get approximately $1,300 a month, and then I get about $800 in Social Security.
And how about your spouse?
My spouse is still employed. He owns his own construction building.
But you're still employed as well. You said you're about to retire.
I am.
But
I am.
you're currently taking Social Security and taking money out of a retirement account.
Correct. Because what we did, my husband's a builder, and so we were living in the house next door, and we wanted to build this one that we're currently living in without any mortgage.
Okay.
So we had to show income to remortgage the other one so we could afford this one.
Got it.
So,
And what's your?
Terri, you got a lot of moving parts.
Yeah. What's your husband's income?
as you might
All
guess,
over the map.
it varies. Yeah.
Yeah, some years great, some years bad.
40 to 60,000, I would say. Mine is currently 88.
And when do you retire?
Well, it just changed today. Now it goes through October 11th. It was supposed to be done at the end of August. But,
And did you already qualify for the loan?
we don't have what loan?
Well, you said you started income to get a loan,
And that's long gone. We've paid that loan off.
but you're still taking the income.
Yeah.
Why-
Should I stop it from
Yes.
the annuity?
Well, you're about ready to
Okay.
retire, so
I would stop.
Right.
In
Really?
October?
No, I mean,
Yeah,
that's
we
right.
would bother.
That's
Okay,
right.
so your question for us is about a Roth?
No, well, I have three questions actually.
Okay.
Should I take money from my IRA that was pre-tax and use that as income because I'm going to have to pay tax on it anyway? Should I do any Roth conversions because I only have about 300,000, well, close to $500,000 that is post-tax.
Okay.
But as I said, I have this 1.3 million that is pre-tax.
Okay.
And then also, I have this annuity, one of the annuities that I didn't annuitize. The 10 years is up in 2027. How should I take that out? Should I take that out all at once and
Okay,
invest it
so
somewhere else?
let me. Yes. So the answer
that
is
just means your surrender charges you
Gone away.
probably just keep it and not.
yeah.
You don't have to do anything in 10
And
years.
that was a post-tax annuity. You put in after-tax money on that one?
No, that was a pre-tax.
Okay. So here's what you wanted. Here's the first thing you want to do.
Okay.
Your husband is a contractor, and he starts with a plan for a building, right? He starts with a plan, and then he has it engineered.
But let's start with a plan. What is it we're trying to accomplish?
What are we trying?
Yeah.
What you build
Yeah.
a portfolio about by going down to Home Depot and just buying things. That's what your
what this looks
portfolio-
like, yeah.
Yeah, and that through no fault of your
That's
own,
very
by the
common.
way. It's very common. You ran into an advisor who was selling annuities at the school, at the university, and they're like, "Hey, do this," and then you're like, "What do I do with this $100,000 over there?" And you're like, "Oh, I got this beautiful thing here. You're gonna love it, right?"
Yeah.
That's how you. That's how you.
Gonna love it.
You're gonna love it. It's great.
Yeah, I don't love it.
So what happened is you've collected things, and by the way, you did a great job collecting. You're a good saver, right? You're a great saver. As you're,
But I'm still worried I'm going to run out.
Listen, and most people that have plenty of money worry they're going to run out, or they wouldn't have money. You show me someone that doesn't care about money or worry about it, I'll show you someone that doesn't have any.
But so your experience in the past, Terri, you've had these financial salespeople that have sold you these products.
They called themselves financial advisors.
But I think what would be
a fiduciary.
Well, part-time fiduciaries.
Yeah. Anyway, go on.
No, but part-time. Look, if you listen to an ad from any of the big firms out there, at the end they will give two disclosures. They're will say
part-time fiduciaries.
They will say securities offered through NASD, SIPC, and then a registered investment advisor. So they're advertising. Look, we own a broker dealer, right? So you could accuse us of being part-time fiduciaries. We don't put new assets to speak of into the broker dealer. It's just
we don't sell products. Our advisors aren't paid commissions by selling products. So.
It's to house, like if someone like you came over and had this annuity that you paid a commission on years ago, we want a place that we can house that we can monitor that away from the firm that sold it to you. And we have to own a broker dealer to do that.
So, Terri, I think what would be really valuable for you is if you and your husband met with a true financial planner, like certified financial planner, even if you just said, I want to pay for, I don't think I want to hire you to do any of my I just want to pay you for a financial plan. And they'll go through and look at all these things. First of all, it's like, how much income could you truly afford to take each month from these accounts? Like, right? Your pay's stopping tomorrow. So how do we make up that income? How do we have confidence that that income is going to be able to continue to keep pace with inflation, and that when you're 93 years old, you're still going to have the income coming in, right? And that's the question number one.
It's, do I have enough money for the income that I need to live?
How do I and then it's, how do we manage all these things in the most efficient manner, both from a tax standpoint? There's lots of moving balls because you've got these SEP IRAs, and you've got non-qualified annuities and Roth, and where do we take the income from? And a good plan can lay out a strategy for all that.
And my guess is that you're going to annuitize that non-qualified annuity. Because,
you think so?
Yes. My guess is because that's the most tax-efficient way to get at it. Even if you have to move it into a no-cost, low-cost annuity to do so, because you've got this basis in it. So, look, I have someone that, a client of mine that has this annuity, and we're doing exactly that. We will, because of that's the most efficient way. Then the second question that Scott pointed at is, okay, where do we have enough for the income we need? Oh, and then where do we take it from? And then the third question is what tax efficiency portfolio strategies should we apply here?
Do we do Roth conversions this year? Do we do them next year? Do we?
How does it affect my tax? How does it affect my Medicare tax? Right. But unfortunately, your experience in the past has been kind of you haven't had a relationship. And by the way, you go and hire a good financial advisor, right? Who's also a fiduciary. So you could be a financial advisor and not manage assets, but you want a fiduciary that's a financial. If they charge you $2,500 to do a plan and you decide to hire them at the end, oftentimes they will actually waive that $2,500 fee if you decide to hire them. But you pay for the financial plan, you get to try it on, you get to ask all these questions. From this conversation,
and you'll have afterwards you'll have a good strategy of what you should be doing, and you'll have increased confidence in your own future.
That's right. At this stage of the game, we can't answer the question because it's hard to even figure out what you own and where you got it. Right? Now imagine
at a basic, you'll have a nice, good spreadsheet that are a nice.
Like imagine, like your husband's a contractor, and someone just shows up with a truck full of parts and says, "Build me a house." He's like, "Okay, so."
People do that.
So they do that, don't they? And what's your husband say?
They do.
What's your husband say?
Oh my God. He's so mad right now. at one of his clients because they wanted to be their own general contractor. They didn't order stuff right. They're trying to blame him. Yeah.
Well, I think so. You understand the difference between a good contractor and a bad contractor. You also understand the difference between a do-it-yourself person who knows what they're doing and a do-it-yourself person who thinks they know what they're doing.
Yeah. I actually manage all my own until we went with this quote-unquote financial advisor when a president that was coming in that was a little bit risky. But I think that was not a best move for me. And we're away from them now. But my husband has another one.
I'm sorry, say that again?
My husband has a financial advisor at Vanguard, and I'm probably going to move.
It's not the same thing. It's not the same thing. You need to sit down with a local financial advisor. What you have at Vanguard is someone that works remotely, that they pay a fee to manage the asset. You're past that. You're past that.
That's. I mean, and I don't want to disparage Van. My guess is if you look at the call center for financial advisors, they tend to be younger. It's kind of a first step.
It provides a service. You need a little bit more in depth than that.
Yeah.
He offered to do a plan for me, but
you can.
Well, if it's free, go for it.
It's free. Give it a shot, and ask all these questions and see if they come back with the right answers. If they say, if you ask, oh, should I annuitize this non-qualified annuity, and they don't have a response as to why you should or shouldn't, you'll know you're in the wrong place.
That's right.
Well, I did.
If it were me, I don't know. If I were at my point of retirement, like if I had a serious heart issue, I'd want the best heart surgeon available. Truly,
absolutely.
I would say, if I had a major health, I want the best, or at least if not the best, I want to at least believe I'm working with the best, right? And if I'm approaching retirement and I've got a couple $1,000,000 saved up and a bunch of different types of accounts and I'm trying to figure out a strategy, I think I'd want one of the best financial advisors.
That's right.
Right?
That's me.
Yeah.
So we appreciate the call.
We wish you well, Terry. It's funny. I think because at least if you go to a heart surgeon, you know that the person that went through medical school, went through all kinds of additional training, all that, right? And
that would be the hope.
Well, otherwise, I don't think they could call themselves a specialist.
Yes.
In the financial services industry, the word financial planner means nothing.
It's nothing.
At least look for a certified financial planner. You know, there's some degree of education there
and financial consultant,
and you're agreeing to certain guidelines and
But chartered financial consultant, which is what the old guys have. By the way, Scott, I'm gonna say something about this last call. I noticed this in last week's show. You are the king of the mixed metaphor. So, you call a lot of, what do you call it?
Did I just do it again?
Yeah, you did it. It's balls in the air. You call balls on the move.
Okay.
Right? You're the king of the mixed metaphor. You always have been.
I was doing a baseball analogy the other day, and then I talked about moving the ball down the field.
Right? So the king of the mixed metaphor.
In the same, yeah.
You used to say,
I do.
He's working his tail to the bone.
Right. Okay. All right. Guilty.
Which, by the way,
I like to think it makes me a little more charming.
Well, I don't think you know what's happening.
I don't.
It's balls in the air.
Okay.
Balls in the air.
And balls on the, okay.
Balls in the air.
You're right. You're correct.
King of the mixed metaphor.
Right. All right.
But it is charming because I've been a business partner for 30 years. And since the day I met you, it hasn't changed
at all. You teased
me
me for 30 years on it.
It's okay.
It's probably not going to change.
It's fingers to the bone, work the tail off.
I don't feel like doing either anymore, by the way.
Right? And where did the word work your tail off? Like you're some sort of a dinosaur? Like you've got this tail that you're moving around so much you're going to work it off. I don't know where it comes from. Like you're a lizard? I don't know. People make fun of our kids' slang. Think about the slang that
we make fun of it.
Yeah, we make fun of it, but think about the slang that we have used growing up or our parents' slang.
My kids, they can't ask a question without it starting with wait. Every question starts with wait. Like, wait, what do you mean? You want me to pull over the car? What do you mean by wait? Every question starts with wait. Have you noticed that, young people?
Yeah, or they'll say that you wouldn't believe this, and they'll tell me something, and I say, I can't believe that.
I've got 2 teenage girls at home right now.
And or I'll say something, and they'll say what, and then I'll just repeat it again, and they're like, "Oh, we're not asking for clarification. That was like wow." I'm like, well, then why didn't you say wow? Why did you say what?
Okay.
If
there's anyone still listening to our show,
I want to be Seinfeld.
Let's talk to. Looks like we have both Vince and Samantha with us. So Vince and Samantha, welcome to All Worth's Money Matters.
Hi, Scott and Pat. This is Samantha.
Hi, Samantha. Hi, Vince.
How are you doing?
We're fantastic.
Good. Yeah, we have a couple of questions here. We just retired a couple months ago, and we're 52, 55. And
how's that going? First of all, I mean, you're quite young to be retired.
Yeah.
It's fantastic.
We're loving it.
Oh, good. All right, good.
As long as there's things to do, we're doing a lot of pickleball and anything else we can do. Taking classes like a pottery class. We're looking into doing glass blowing, all the things we couldn't do while we were working and stuff like that. So
wow.
How long have you been married?
Hold on. 26 and a half years.
Wow. Okay.
All right, well, good for you guys.
Good for you.
Yeah.
All right. What's your questions for us now that we've caught up on young retirees' lifestyle?
Yep. Yes. And we have time, so we're looking to develop some Roth conversion plans we have. And, how much should we convert? Should we worry about the 22, 24% tax brackets based on what we have? And also in the future, like Social Security, should we wait till 70 to collect so that we can do more Roth conversion so it doesn't add to our total income every year?
All right. So walk us through
on the Social Security at the earliest you can qualify is 7 years.
Don't worry about it.
I wouldn't be spending a lot of time on Social Security.
We're gonna defer any decision there. So walk us through your assets. What do you have?
We're not. I said say 7. I said 70. Should we wait till?
We don't. The earliest you could take it is in 7 years. So
for one of you, and 10 years for the other.
Yeah,
so I wouldn't even.
We're not gonna really.
I wouldn't worry about it.
So let's tell us what the assets are and where they're at, and tell us about your debt situation.
All right, so summary in the traditional IRA and a 457, we have $3 million in there total. In Roth IRA, we have about 370.
Wait, one second. Can you actually tell us how much you have in traditional IRAs and in 457 separately? Because the tax rules are significantly different between those two.
Okay.
So in a traditional IRA for both of us, we have about $2 million, and then for 457, we have about $900,000.
Okay.
Between the both of us.
Okay.
Got it. And do you have pensions?
Yes.
Yes. And for our gross income, including pension, interest from bank CDs and dividends, it's approximately $178,000. And then, go ahead.
And how much money do you have in brokerage accounts and in bank CDs, that sort of thing?
Okay, so in a Roth IRA, brokerage account, sorry. Brokerage account, we have about $760K.
Okay.
And then go ahead.
No, go ahead.
Roth IRAs?
Oh, I was going to say
370 in Roth.
Savings and CDs, we have about $700,000. Because we sold a house last year, and currently we're living in an apartment and trying to figure out where we want to live. Do we want to buy a house and things like that? So that's in there right now. And then checking, we have about $50,000 there.
And do you guys have kids? Grown kids?
They're out of the house.
Where do they live?
They live in Sacramento.
And you're in Sacramento?
Oh yeah, I guess I am.
So you'll probably stay in California for the.
We are. We also have other family members older than us. taken
Yep,
care of.
I get it.
And why did you sell the house and move to an apartment?
Different lifestyle, and downsize, and it go to. I mean, we're not that far away. We only moved about 40 minutes away, but it was just kind of like make a change in our life.
Yeah.
We had lived the other place for about 24 years.
And the nice thing now, when something breaks, you just call one number. There's not.
Is the goal
Exactly.
to buy a house again or to stay in rentals?
We're actually not sure at this point.
Yeah. We're still exploring. We're still in. It was over a year and a half ago, and so far I guess it's like a different lifestyle, and taking our time right now.
And what was your income, for the both of you, before you retired, annual income? So your pensions and interest and whatnot's about $178,000. What were you guys earning before you retired?
Our income was about the same because we were putting so much into our 401 and 457.
That's what we suspected.
So our income has not changed at all.
And so the question for us is Roth conversion.
What is it you're trying to accomplish?
So what do you mean?
Well, we know we can't avoid taxes, but we want to minimize the amount of
In
taxes.
the future, because the $3 million in our pre-tax, that's just going to keep growing, and eventually RMDs are going to come into play.
That's right.
So,
Yes.
And so that's why we're talking about, like Samantha said, we're trying to minimize it, but there's a fine line. We don't want to convert $3 million 1 year and then pay a huge tax.
Of course, then you're paying the highest tax bracket.
Yeah, here's the situation. If we converted to a Roth, it makes sense to do some. But you're in this. I wouldn't want to use up a lot of that savings or the brokerage account to pay the taxes on it.
We need to, at some point in time, you need to buy another house.
That would be our advice.
Just because from an inflationary hedge, it just provides a lot of security.
Yeah, and you're really young.
Yes,
you're really young.
And I can understand why you're in no hurry.
And you were both. You worked in. My guess is you retired from the state of California. You were both safety workers.
Yes.
And you. So let's assume the savings is going to go for some other future house. And to Pat's point, you wouldn't want to work so hard at the conversions that you've got down the road, and your brokerage account is suddenly a really small, at a small place. But you've got enough. Is there much cash in that? Or would you have to sell something to generate cash to pay a tax liability on a conversion?
No, we wouldn't.
No.
Yeah, but Scott, how much would a house cost then? So this is, look, we have listeners all over the country. These people happen to be in our backyard. So we're very familiar with the marketplace, and we're very familiar with the scenarios because in the state of California, you can retire as a safety worker at age 50 with 90% of pay in many cases. So that's how we guessed all these things. A house here would
and what about the property tax carry forward? What's the time frame we have?
Oh yeah, did we lose any of that?
Yeah, I don't know off the top of my head.
Yeah, there's property tax. We're not going to be in that because there's like the 2 years for keeping up with your old property tax. We understand that, but like we said, the rental we're doing is still within the scheme of our.
So let's back up a little further again. So you want to save money on taxes, but you've got let's just call it $4 million in retirement accounts, right?
And by the way, leave that money in your 457. Do not move that money to an IRA.
That's why we're doing that.
Because it's liquid.
We did that as soon as 3 days after we retired, we already moved our 401 into traditional IRA.
So my
wait. But you left the 457 where it's at.
Yes.
Okay.
That was what we did.
But I guess here's my question, right? So you guys have been good savers. I guess you were maxing out both the 401k and the 457 for a period of time, or at least contributing to both. Your pensions are roughly what your take home pay was before. And you're early to mid 50s, and you have $4 million for retirement that you're not spending. That'll be worth 8 million, let's say in another decade or give or take, right?
And that's $3 million
And then
in the. That's $3 million in the.
I'm just looking at. I know, but I'm just looking at what are your. I'm taking the $700,000 in the savings.
I apologize. Yeah,
No, you don't have to apologize. So you've got $4 million saved. That is going to grow to 8 million, 10. Like, so I guess my question is, do you want to use any of your retirement savings, what you saved for that now you're now retired, to help supplement your lifestyle? Or do you want to just do the best you can to maximize your growth and minimize taxes so that this continues to grow for years?
Yeah, I see what you're saying. Yeah, like I said, it's sort of, I mean, we have, like you said, $4 million. I mean, we're comfortable with that. It's not like our goal to go and, generate $20 million. And, we want to protect what we have at the same time. But our lifestyle, is not, spend, but it's, but we want that ability to spend.
Yeah.
Okay. So look, you should absolutely run the test to see how much you could do in a Roth conversion. The thing that I would
definitely do some Roth conversion every year.
That's right. But it won't be, I don't know, it won't be a ton, but it will be some. But the thing that you really need to consider is this inflation hedge by owning a home. Right? I know you're living in an apartment now. It was a big change, but I don't want to use up all that brokerage account or that savings account to pay taxes on the Roth conversion, only to find in 3 years, 4 years, 5 years that you end up buying a house.
And it might be a condo of some sort, townhouse of some sort.
Yes, it might be something. Look,
but if you think about real catastrophic events and hyperinflation, that's when if you own your home, it just puts you in a completely different situation. Even the way you act as an investor, like we led people through the financial crisis, and those that owned a home paid for had a very different perspective on their future because they're like, well, I know that I got my house, and they were able to withstand the markets and stay invested, and they benefited by the recovery that.
Now, if you were 75 or 80. And you said
different.
I was living in an apartment, I'd say, okay, all right. But you're 52 and 55. One of you is going to live for
40 years.
Yeah, 35, 40 years. And there's a lot of things that can happen in that time period that you leave yourself exposed to inflation, right? Yeah. And I remember 3 years ago when I was looking at a property to buy, and the rents were increasing by 3% a year with no adjustment for inflation. And the guy said to me, what do you care what the leases are? It's above that rate of inflation. And I said, don't believe that inflation's going to be.
This was no inflation. There was no inflation.
This was 3 years ago. I don't believe that inflation won't happen again. And look, the inflation is down now, but don't believe it's going to happen again. It won't happen again because it will happen again, right? The Federal Reserve actually is designed to avoid big booms and bust if it can, but it's not perfect. It's not perfect.
Okay. I clearly like the strategy, though, of let's see how much we can convert from the pre-tax to the Roth. But I would do it. I wouldn't go hog wild.
That's right. I'd do it a little at a time. And then I'd think about,
because you are volunteering to pay taxes at a certain rate today for a promise of the future that
I think that's still it's a winning bet for a portion of the portfolio.
Yes,
as long as we didn't use up all $1.46 million in order to pay those taxes, because you might find that you have the perfect house that costs $1.3 million. It's your dream home. Someone comes and mows the lawn every day and empties the trash, and it looks like an apartment. Like there's nothing to take care of. And
you have the financial resources to do that if you want.
You can pull the trigger in a minute.
Yeah. Well, and that's why we're not looking at converting all at once. We know that. But this is more like $20,000, $25,000 a year each in our to convert.
That's probably right.
Yeah.
That's probably right. And what you do is you just run the numbers up to the next marginal tax rate, decide what the conversion is, and you do it every November, December.
Yeah.
And it's easy.
So,
a good financial advisor could tell you in a minute, or an accountant.
Yeah. So yeah, like I said, so it's kind of like trying to develop a strategy, and I know we can't predict what the taxes are, but
well, it's going to be fluid. It'll be fluid. So you're going to want to do this every fall and look and run the numbers every November. And it's like, all right, how much did we convert this year?
And this year, 31,000 or 25,000. Who knows what the number is, but you do it every year, and then you convert that amount, use that money in your brokerage account to pay taxes on it.
Yeah, it doesn't seem like it'll make a big dent into like doing 2025, but it was a K a year conversion, but over the 3 million. But it's something.
No. It certainly helps. Anything helps, because what you're worried about is required minimum distribution for you in 20 years and 23 years, and that will actually lower that required minimum distribution. But I think with this, you need to
be pretty confident you're going to remain in California. Because you're choosing to send Sacramento about 10% of the tax rate. You're right. You're roughly a 10%, 9 point.
Yeah, and if you move to Nevada or Texas or Florida or Washington State, there'd be none of that.
We would not have retired so early if we couldn't afford to live in California.
Okay.
Because we knew that. So it's all within the scheme of our planning of it and taking the leap here, and not. It wasn't a blind leap.
Got it. And
thing.
you guys,
look, I love
I'm going to live here as well.
Me too.
That's just the way it is. And by the way, great savers. Congratulations. You guys have done a great job saving. And good investors, I assume, because your IRAs and 457s were all equity investment, or most equities over that time period, or you wouldn't have grown those account balances that large. Fair statement?
We started early.
But you weren't conservative investors. You were relatively aggressive investors.
Yeah, we started $50, 30 years ago, and over time, and
makes such a difference.
And anyway, also we made errors, mistakes. We learned, changed it how we did, and
great.
It's time period.
Well, congrats. Enjoy the pickleball.
Yes. Enjoy the glass blowing.
I got a text this week from a good friend of mine who
appreciate the call.
Pulled his tore his
Thanks, guys.
Tore his Achilles playing pickleball. So I tore my Achilles. How'd you do that? I was playing pickleball.
I can't play. It tears my knees up.
You talk to like physical therapists. They're like,
"This is the greatest thing ever."
Greatest thing ever.
This is better than snowboarding for an orthopedist. A wrist doctor.
You're moving your office. Where's your office? It's right next to the pickleball courts. Hey, I want to chat about this when I mentioned at the start of the show. The difference between investor and investment returns. Okay? So this was Morningstar, and I've seen these. Pat, you've seen them forever, right?
Yes.
Morningstar just released a study showing the 10 years ending on December 31st of last year, 23, right? The average investor earned 1.1 percentage points less than the mutual funds and ETFs that they actually owned.
How can that be?
Well, what happens, this is pretty common. Let's say you own 6 different investments. You own a large cap growth, you own a large cap value, you own a mid cap, you own a small cap value, you have an international, you've got a global, whatever, right?
Real estate.
And each year you look at how these things do, and you watch this, wow, this one fund, it's really been underperforming. Wow, it's 2 years in a row of underperformance. Wow, 3rd year in a row. And so what ends up happening?
I've got to do something.
This thing's been underperforming. I need to move it to something that's performing better. So you sell that, and you buy into something that has already performed better and is up in price, which is why the average investor earned 1.1 percentage points less than the underlying investments. All timing.
All time is When I first started in the business 30 some odd years ago, there's this guy who was considered the investment guru in the firm, Kyle Meitzner.
Yes.
Do you remember Kyle? And
He's probably still around.
I don't. Maybe he is. I don't know. But he always used to say it's time in the market, not timing the market, right?
I don't know if he coined the term, but anyway, yes.
But that's what he said. And by the way, I was brand new, so I thought it was him. So
Genius. Yeah.
But that just it sounds simple, but it's fighting your base urge.
Now, if you look at sector funds, right, like technology, energy, whatever, these sector funds, the same 10-year period, sector funds, the average investor did 2.9 percentage points worse than they had they just owned the basket.
Makes sense.
Because you get even like technology in 2022, the technology index Spider was down 28%. It was up 56% the next, but you had to own it the next year.
Yes, it didn't help if you.
So
had sold
just
it.
a good reminder, like the hard part is not picking the investments. The hard part is living with the investments. And the biggest risk is not the markets. The biggest risk is the investor.
Well said.
Well, that's all the time we have. It's certainly been great being with you. You've been listening to Scott Hansen and Pat McLean of Allworth Financial.
This program has been brought to you by Allworth Financial, a registered investment advisory firm. Any ideas presented during this program are not intended to provide specific financial advice. You should consult your own financial advisor, tax consultant, or estate planning attorney to conduct your own due diligence.